Hey everyone, and welcome to The Explainer. So, could your 401k be the next crypto whale? It sounds kind of crazy, right? But today, we're diving into a massive, under-the-radar shift in the financial world. A structural change that could connect trillions of dollars in retirement savings to crypto, and it might just be a bigger deal than the Bitcoin ETFs. So, what's going on? It all kicks off with a recent executive order signed by President Trump. In this single document has potentially changed all the rules for what's allowed inside your retirement account. The implications here are just enormous for both Wall Street and the world of digital assets. Okay, let's get right into it. A new order for 401ks. We're going to break down what exactly just changed and why it's such a big deal for your retirement savings. At the heart of this order is that it opens the door for 401k plans to include something called alternative assets. Now, this is just a catch-all term for investments that aren't your typical stocks, bonds, or cash. You can think of it as the stuff that, up until now, has pretty much been reserved for big institutions and the super wealthy. So what are we talking about exactly? Well, this isn't just about crypto. It's a whole basket of things. We're talking private market investments from huge firms like Blackstone. We're talking real estate, commodities, you name it. And right there on the list, digital assets, which is the official term they're using for crypto. It's now in the same category, part of a much bigger puzzle. Now, to really get why this is a complete game changer, you have to know the old rules. The people who manage retirement plans are called fiduciaries, and they can be held personally liable if they make what's seen as a risky decision. So when regulators use the phrase extreme care when talking about crypto, well, that language basically froze crypto out of the entire system. I mean, who would take that risk? But now the Department of Labor has officially walked back that warning. They've gone to a neutral stance. And that might just sound like a small change in wording, but believe me, it completely flips the script. It changes the entire risk calculation. It is, for all intents and purposes, a green light for these fiduciaries to start seriously looking at these assets without that fear of immediate legal trouble. So, how would this all actually work? It's not like you're going to log into your retirement account and see a Buy Pepe button next to your S&P 500 fund. No. The mechanism is way more subtle, way more institutional than that.
The whole process is automatic, and it just plugs right into the financial plumbing that's already in place. So every payday, your contribution goes to a record keeper, like a Fidelity or a Vanguard. They put it into the funds you've already chosen, maybe a target date fund. Now, if that fund happens to have a small allocation to crypto, say 1%, the fund manager automatically buys a little bit of a crypto product, like a Bitcoin ETF, to match. It all happens in the background.
And this automatic process creates something that people are starting to call the infinite bid. Think about it. Because this buying happens every 2 weeks with every paycheck, all across the country, it creates this constant mechanical flow of money into the asset. The fund manager isn't trying to time the market, they're just rebalancing. If crypto's price drops, they buy more. If it rips higher, they trim some. It's just systematic, totally emotionless buying pressure. To really understand why this is such a monumental deal, we have to talk about the sheer scale of the money we're dealing with. And honestly, it is absolutely staggering. As of the first quarter of this year, there is $8.7 trillion held in U.S. 401k plans. That's trillion with a T. That is the total pool of capital that could, for the very first time, have a regulated and systematic path into the crypto markets. So let's just run a few quick scenarios. Even in a really conservative case, let's say only a quarter of plans adopt this, and they allocate a teeny tiny 0.25%. That's still over $5 billion in new demand. What about a moderate scenario? Half of all plans allocating just 1%. Now you're talking over $43 billion. And if things get aggressive, you could be looking at almost $200 billion. These are just enormous numbers for any asset class.
And to see the real impact, you've got to look at this on an annual basis. Every year, about $19 billion worth of new Bitcoin is created. Now look at this. The ongoing annual contributions from 401ks, even in that moderate scenario, would create almost $3 billion in new demand every single year. In an aggressive one, that's over $12 billion. That is a significant chunk of all new Bitcoin supply being soaked up by retirement accounts. So, given this potential earthquake of a shift, who are the biggest winners? And maybe more importantly, what does this actually do to the crypto market itself?
Well, the biggest and most immediate winners will almost certainly be the established financial giants. We're talking about firms like BlackRock and Fidelity. They're already deeply embedded in the retirement system. They have the distribution channels, and crucially, they have the brand trust that fiduciaries depend on. Now, the crypto native firms, they'll fight for a piece of the pie for sure, but they have a much steeper hill to climb. So here's the bottom line. This could fundamentally change the whole character of crypto. Bitcoin and Ethereum, with ETFs already out there, will be the main beneficiaries. The money is stickier since it's for retirement, not for day trading. This could lead to flatter market cycles with way less of the wild volatility we're all used to. It's another huge step in legitimizing crypto as a real institutional asset. And that could even reduce panic selling in the broader altcoin market during big downturns. Okay, this change isn't going to happen overnight. There are still a few key steps to come on the road from this executive order to it becoming a reality in your retirement plan. All right, so the order is signed. What's next? Well, the Department of Labor and the SEC now have 180 days to review all the existing guidance and propose changes. But the real prize, the thing everyone is waiting for, is the potential creation of a safe harbor framework. You can think of this as a legal playbook that, if fiduciaries follow it, gives them significant protection against lawsuits. That is the key that will truly unlock the floodgates. So, while this isn't about giving everyone a button to speculate on meme coins in their retirement accounts, the potential impact is profound. We're talking about a structural shift from retail-driven speculation to systematic, long-term retirement investing. And that could have consequences far, far beyond just the price. That's the key thing you should take away from this explainer. We may be witnessing the beginning of a much tamer, more institutional era for crypto.